our tax director, and take it away, Mike.
Thank you, Lorianne. Hello and welcome everyone to today's Singer-LeWack webinar presentation on the tax law changes from the OBBB Act that was passed and signed into law last month. My name is Mike Mondelli. I'm a director in Singer-LeWack's Tax Advisory Group, and I will be moderating today's panel. Joining me are some distinguished tax partners from our firm: Shannon Carlson from Southern California, Kevin Gienger from Oregon, Stephanie Gunderson and Steve Giorgione, both from Nevada, and Gary Rand from Colorado. Today, we are going to discuss a number of individual and business tax changes, but there are many more in the bill that we won't have time to cover today. And since this legislation is only 6 weeks old, we're still waiting for the Treasury Department and Internal Revenue Service to issue guidance on most of the tax law changes. In some cases, we may be waiting quite a while for a couple of reasons. First is that some of the changes do not take effect until 2026. So issuing guidance quickly for those items is not at the top of the priority list. And the second is that the IRS headcount is down about 25% this year due to layoffs, retirements, and attrition. So some of their guidance may be delayed. Shannon and Kevin will discuss some of the individual tax updates. Then Steph, Steve, and Gary will discuss some business tax updates. And if you have questions today, please use the chat feature, and we will answer some of your questions at the end of the webinar today if time permits. So with that, let's get into some of the individual tax changes in the OBBB Act. Shannon, I think we're going to start with you. What can we take away, or what should we know about changes in the individual income tax rates? Or maybe to put it another way, have there been any changes in the individual income tax rates?
Thanks, Mike. Good morning, everyone. No, there actually haven't been changes in the rates themselves. As most of you know, the Tax Cuts and Jobs Act 2017 lowered the individual tax rates from a top rate of 39.6 to a top rate of 37%. They also lowered some of the interim rates. It expanded a lot of those lower brackets so that more income was being taxed at lower rates. However, these changes under the TCJA were temporary and were set to expire after 2025. The One Big Beautiful Bill, which I will refer to as OBA, made these changes permanent. So a quick terminology note here on the word permanent. To a lot of people, that often implies fixed and unchangeable, but there's really no such thing in the realm of tax law. So what permanent means in this context is that there's no automatic expiration date. These lower rates will remain until new legislation is passed to change them. The only automatic change to the rates under OBA is to index them for inflation, which means the brackets or the income taxed at each rate will change, but not the rates themselves.
All right, so this seems like a positive for us, at least until sometime in the future when the tax rates do change. But for now, we're not anticipating any automatic changes in the rates because of any sunsetting of any previous legislation. Right. All right, now I did see that the standard deduction is now going to be permanently increased as well. What should we know about the standard deduction?
Yeah, this is another item that is tied to the Tax Cuts and Jobs Act of 2017, which nearly doubled the standard deduction for federal purposes. Some of you may remember that prior to the Tax Cuts and Jobs Act, the standard deduction for a single filer was only $6,500, $13,000 for joint filers. After that, though, it was $12,000 for single filers and $24,000 for joint filers, indexed for inflation. So these expanded amounts were also set to expire after 2025. And like the tax rates, the OBA made them permanent. Thus, rather than a reversion to the lower amounts in 2026, we'll have an inflation-adjusted amount of at least $15,750 for single filers and $31,500 for joint filers. So many more people find themselves taking the standard deduction under this new law and will continue to do so under OBA.
Do you think this is going to impact the number of taxpayers who itemize by a large amount? Will we see more people itemizing, fewer, or to be seen?
I think this change happened when Tax Cuts and Jobs passed. I don't think we'll see a change per se, but those people who've been taking the standard deduction for the last, well, since 2017, 2018, they will continue to do so probably.
Sounds good. We may see a little interplay with this standard deduction amount and the SALT cap changes, which we'll discuss in a few minutes. We'll come back to that topic. The enhanced deduction for seniors. This is kind of an interesting one that I think may have something to do with what people have heard about Social Security maybe not being taxable anymore. Does this new deduction for seniors sort of take away some of the taxability of Social Security or other income, or what's the rationale behind this one, do you think?
Well, this has been very much misrepresented in the media in several ways. First, as you mentioned, it's been touted as an elimination of tax on Social Security, but it's not that. In fact, this isn't really even tied to Social Security at all. Right. Social Security will continue to be part of the tax calculation as it has been since 1983. For some taxpayers, their tax on their Social Security may be offset by this new personal deduction for qualifying seniors, which leads me to the second somewhat misrepresented terminology. A lot of people are calling this a credit for seniors, but again, it's a credit is a dollar for dollar reduction of your actual tax due, whereas a deduction is reduces the total income from which your tax is calculated. So OBA sets this new enhanced deduction for seniors at $6,000 per individual who has reached the age of 65 by the end of the year. However, it will be incrementally reduced for single filers with modified adjusted gross income exceeding 75,000, and for joint filers, the threshold is 150,000. So the higher income folks are not going to get the advantage of this deduction.
And if you have two married seniors that qualify, can they both get the $6,000 exemption?
Yeah, they sure can. A couple of fun facts about this deduction is that both can get it, but they do have to file a joint return. They can't do married filing separately or they won't get to take it. This is also available beginning in 2025, but it is not permanent. It is expire for tax years beginning after 12/31/28. So starting in 2029, without any additional legislation, this will expire. The deduction is not indexed for inflation, so it's going to remain at $6,000 for all the applicable years. But on the good news side, it is an above the line deduction, which means you can take both this and the standard deduction together. You do not have to itemize to get this deduction.
So this new senior deduction might influence some retirement planning or income distribution amounts, but because of the income phase out ranges here, I think the effect of this will be somewhat muted for a large group of retirees. Do you think that's going to end up being widely utilized, or I guess we'll see starting on next year's 2026 tax returns?
I agree with your statement, and I think a lot of people are going to be disappointed when they go see their tax preparer next year because, again, they think this means I don't have to report tax on Social Security, but unfortunately, that's not exactly what the bill said.
We'll see. We'll see what happens. Yeah, everyone that's a tax practitioner will get a lot of questions, I'm sure. Let's move on to the state and local tax, aka SALT cap. I know this previously was limited to $10,000 as an itemized deduction under the TCJA, but it's increased by quite a bit now. What's changed about the SALT cap deduction?
Yeah, so the SALT cap, this is one of the most anticipated provisions of OBA. We all remember the good old days prior to TCJA when we could deduct pretty much all of our state and local taxes. But unfortunately, it was capped at $10,000, as you said, in the Tax Cuts and Jobs Act. But OBA came along. We weren't sure what they were going to do. We those of us in high tax states really hoped we'd go back to the good old days. We didn't. They kind of gave us a compromise. So instead of getting to deduct everything, or instead of being limited to 10,000, they have raised that cap to 8,000. This is per return, so single filers are getting a bigger bang for their buck than married filers here. The larger cap will start applying in 2025, though, and will be adjusted annually for inflation. But again, not permanent, only through 2029. Without further legislation, the cap will revert to the $10,000 limit after that date. Another important note, though, is this cap is incrementally eliminated for high income taxpayers with modified adjusted gross income over 500,000, which will also be adjusted for inflation. So at a certain point, you're going to get back to the 10,000. 10,000 is the minimum cap. So once you eliminate the extra 30,000 that the new bill provides, you're not going to go any lower than the 10. So for really high income taxpayers, some planning needs to be involved here.
So if you have, more than 10,000 in state and local taxes, that would qualify as an itemized deduction. If you have the income phase out, still be able to at least 10,000 of your qualifying taxes. But I guess that brings me back to the question I posed a couple of minutes ago when talking about the itemized deductions versus the standard deduction amount. If you are capped here because of your income range, you can only take a $10,000 deduction. Do you think a lot of individuals will be able to exceed the standard deduction amount? Or maybe what are some of the other itemized deductions that they would want to make sure they're taking advantage of, charitable contributions, et cetera, to try to exceed the new, the itemized or the standard deduction and be able to itemize and even get their 10,000 insulted.
Right, you're absolutely right. Unlike some of these other deductions we itemized to get it, it's not in addition to the standard deduction. So we're going to compare the two. Some of the other itemized deductions that you can use in addition to this 10,000 or 40,000 or somewhere in between, SALT cap, are mortgage interest, charitable contributions, medical in limited circumstances. So these are things that can all come together to get you above that standard deduction amount.
All right. Is there anything else that we should know about this SALT cap before we move on to the next topic?
The SALT cap really for business owners needs to be kind of looked at in relation to the PTE credit, which my colleague Gary is going to talk about in a little bit. So if you're wondering about that, there's more to come.
Sounds good. All right, the next two topics, I'm sure people have heard some, or maybe they've even heard what they think is a lot about. It's no tax on tips and no tax on overtime. So I think, from what I've seen online, what I've read, what I've heard, I think there's some large misconceptions out there about what qualifies in these. And because it's not as simple as saying tips no longer are taxed, and it's not as simple as saying overtime is no longer taxed. So let's start with no tax on tips. What should we know about that?
Yeah, this is, as you said, another provision that's really been misrepresented in the media. And frankly, even in the title of the bill itself,
Right.
the section of the bill, this is not a blanket elimination of tip income from your tax return, but rather it's another deduction allowed against qualified tips limited to 25,000 per tip earner, with the deduction being incrementally reduced for highly compensated earners. So I'll get into some of those definitions in a second, but I wanted to point out a few things. This deduction does apply in 2025, but again, not permanent. It is set to expire after 12/31/28. It's another above the line deduction, so you can take both this and the standard deduction together. If both spouses on a joint return receive tip income, both may be eligible for the deduction. Again, though, they have to file jointly, no married filing separately. And you must have a social security number that your employer reports on on your W-2 or your 1099, the qualified tips. We don't know yet what that revised form is going to look like, but we assume there's going to be some kind of separate box delineating this. So business owners out there, this is going to be something you have to deal with for your employees coming up this year, beginning in 2025, which is going to be a little bit complicated because we're already how far into it to go back and kind of recapture those numbers. So hopefully more to come on that from Treasury.
I think so. To further complicate it, though, Shannon, the IRS recently announced that information returns like W-2s, 1099s, they're not going to be revised for the 2025 tax year to reflect any of this. So we're still, yeah, we're still awaiting some real guidance as to how this information is going to be reported for 2025. I don't think that the Treasury Department and the IRS can just sort of kick the can down the road to 2026 administratively on the the putting this into place. But if there's no way on the tax forms, the information reports that everyone sends to their employees or contractors that would report this, I'm not sure how anyone's going to report it on their 2025 income tax return.
Yeah, Mike, can I jump in here for a second?
Go ahead, Steve. Thank you.
On the W-2 already, obviously I'm from Las Vegas, so we have a lot of tip earners here. There is a box for Social Security tips on the W-2 already. So they may use that box to help determine who's eligible. Just a thought.
Thank you. Yeah, I think a lot of this will fall on the individuals themselves this year. So as tax return preparers, we'll try to help our clients sort through this. But I think based on what people see on social media these days, there's probably a lot of people across the country that think all of my tips are not taxable anymore.
Yeah, there are some definitions I want to discuss really quickly related to that. The bill discusses highly compensated earners. What does that mean? These are single filers with adjusted gross income of 150,000 or more, 300,000 for joint filers. At the point that they reach this limit, the deduction begins to phase out. It's $100 for every 1,000 of income over the threshold. So that's something to keep in mind. Also, for business owners who receive tips, the deduction is limited to net profits of the business. So that's something to consider. And then lastly, I want to just quickly touch on what are considered qualified tips. The bill uses this language. These are cash tips earned in the course of an occupation that customarily and regularly receive tips prior to this law. It does not include specified service trades or businesses. And the tips must be paid voluntarily without any legal consequence for non-payment, non-negotiable, and determined by the payer. What does this mean? Great question. We're going to need to wait for additional guidance for some of this verbiage, but I do have a few possible takeaways. I think as to the first one, cash tips earned in the course of an occupation that customarily and regularly receive tips. What they're doing here is they're trying to eliminate people reclassifying their administrative assistants. We're going to lower her salary, but we're going to pay her in tips now. So yeah, that's not going to work. I think it's going to stick to the people that we all are familiar with: food and beverage servers, bartenders, bell service, valets, as Stephen mentioned, casino dealers, those folks that are receiving tips, beauty technicians, et cetera, et cetera. So I think that's what we're going to look at, but Treasury is going to publish a list, hopefully before the end of the year, so we know what we're dealing with. The second thing they talked about was specified service trades or businesses. That means your professional services people, your accountants, your medical, legal, financial brokers. I don't think any of us are really getting tips, so I don't think that's a big problem. But that does also include performing arts. So I'm a little concerned that this might affect like musicians, dancers, etc. And then the last point, number 3, the clause that it must be paid voluntarily and determined by the payer. I think the question is, will that exclude like catering or large party tips that are automatically included in your bill?
Where you get like the 15 to 18% gratuity automatically applied on the check?
So I think that's really unclear, and we're waiting for Treasury to provide some guidance on that as well.
All right. Well, just like with many things, guidance is forthcoming for sure on that. Let's move on to no tax on overtime, which just like no tax on tips, it's not the case that all overtime is now exempt from tax, is it?
That's correct. It is not. It's very similar to the treatment of tip income. It's important to note again that this is not a blanket elimination of overtime earnings, but rather a deduction allowed against qualified overtime. This deduction, though, is limited to $12,500 per earner, with the deduction being incrementally reduced for those highly compensated earners. Again, similar to tips, this applies for 2025, but is not permanent and is set to expire after 12/31/28. Again, as Stephen pointed out, there is a box for tips on the W-2 already, but there is not a box for overtime. So we, again, more guidance, awaiting more guidance from Treasury on how to do this. Similar to the tip deduction, this is an above the line deduction, so you can take both this and the standard deduction together. If both spouses receive qualified overtime, both may be eligible for the deduction, but again, have to file jointly. And then, of course, you have to have a Social Security number. Highly compensated earners are the same as they are under tips, 150,000 for singles, 300,000 for joint filers. It phases out in the same way. The one definition unique to this is defined as qualified overtime, which the bill says is overtime paid under Section 7 of the Federal Fair Labor Standards Act. To save your Googling time for something more fun, I have the verbiage here. Overtime is covered non-exempt employee pay for hours worked over 40 for any fixed and regularly occurring period of 7 consecutive 24-hour periods at a rate of not less than 1 1/2 times the regular rate of pay. Hours worked includes all time during which an employer is required to be on duty at a prescribed workplace. One last note, tip income is specifically excluded from the definition of overtime pay, so no double dipping here.
I also saw that in some recent guidance, the IRS clarified that the amount that qualifies for the overtime deduction is only the pay that exceeds their regular rate of pay. So if they're making time and a half, it's only the and a half that is excluded here. So I think that a lot of the legwork is going to be done by employers here by tracking this, and somehow, when the IRS revises the W-2s, they'll have to report it. What's the amount of qualified overtime here? And anyone who prepares their own tax return on their own without the help of a tax advisor may see a surprising amount is taxable when they fill out their 1040 at the end of the year versus what they're expecting if they think that whole 1.5 times pay that I got for my hours over overtime were not exempt. So thank you, Shannon. In the interest of time, we're going to move on to Kevin's portion. So thank you. Kevin, let's go ahead and talk about wagering loss deductions and what's changed here with this.
All right, thank you, Mike. Well, as Shannon mentioned at the beginning, a number of these provisions are just really extensions of the Tax Cut and Jobs Act that were set to expire. So this is a similar one. They've changed it slightly, but the rules for 2025 are the same as they have been since that change. And then going into 2026, if your wagering losses do not exceed your gains, they're going to be limited to 90% of those losses. So a little change in this specific provision here.
I saw that there's been some subsequent legislation already introduced in Congress to roll back this change and get back to full deduction for wagering losses. Do you have any thoughts on the likelihood of that being passed? Because I know Steph and Steve in Las Vegas, their clients must be really interested in this.
Yeah, so in my practice, I don't see this play out at the same level. More, I guess, the casual person, whereas they probably deal with the professional side more, where I believe it's probably a lot bigger deal. It's a challenging environment, obviously, as we've seen, to get legislation through. So I will be surprised, I think, if there's able to put something together this year.
All right, let's talk about miscellaneous itemized deductions. I think people were expecting the Tax Cuts and Jobs Act to expire, and we would see some welcome news in this area. But what has happened now?
Similarly to the wagering losses, this is another area where this piece has been made permanent, so we're not going to see these come back. There is one change where they're going to pull the expenses. They've expanded the definition for the educator expense and pulled that out of this list of miscellaneous deductions. It's probably good to note that not all states, I don't think we mentioned this, connect directly to the federal law. So in your specific state, you may still see these as deductible expenses if, of course, you're itemizing, which Shannon covered the changes to the itemized deductions, which is a lot. And so I think we'll see a few more people itemizing, but it's probably going to depend a lot on where your income lands in those phase out ranges.
Yeah, and speaking of phase out ranges, there's this so-called piece limitation. How does that affect your itemized deduction limits?
Well, they didn't allow the piece limitations to be permanently suspended. They decided to come up with a new calculation that I think it's going to be simpler. And it's probably good to note that this is going to apply to taxpayers that are in that largest tax bracket. That's around $750,000 of income for joint filers and probably a little over 626,000 for single filers. So it's good to note this limitation will apply after the other limitations that we covered earlier. But if you're in that largest tax bracket, just to simplify, you're going to see the total itemized deductions be limited a little bit after this year.
Okay. So yeah, I'm trying to wrap my head around some of these calculations, and I'm wondering, does this calculation for this phase out, does it affect charitable giving or other tax deductible behaviors, do you think?
I think if you're in this area, it affects all of them. So if you're at this income level, you're going to be first limited by some other items, both for the SALT deduction and the charitable deductions going after 2025. So that it's probably good if you're one of these taxpayers to talk to your tax advisor, because there may be some other opportunities to get, I guess, a better tax benefit if charitable giving is one of the things that normally lands on your itemized deductions.
Okay, sounds good. Let's talk about the estate tax and gift tax exemption amount here, which this really does not affect a very large portion of the population, but it does get a lot of coverage in the media and just in general online. So what's different here now with the estate and gift tax exemption?
Well, as we've mentioned a number of times, this was another large change that was going to expire, and there's probably a lot of attorneys and tax people working with their high net worth clients to beat this deadline in case they weren't able to get something changed. So we now have, as Shannon mentioned, as permanent a change as we can have in tax law. Starting in 2026, we'll start indexing this $15 million lifetime exemption forward from that point, as opposed to falling back to somewhere around that $13.5 million mark that would have that was in play and that was set to expire. So it's not a good reason to postpone your estate planning if you were working on that. It's still important to continue through that process. But you do have now more time if you were racing against this 12/31/2025 clock.
And because this has been made permanent now, it seems unlikely that we will see another situation where the estate tax has expired for a year or anything like that. That shouldn't happen, at least in the foreseeable future, until some other legislative change is made, right?
That's true. So hopefully we'll have some foresight if there's law developing that's looking to change these exemptions in the future.
Okay. All right. There's been some changes in what expenses qualify for use for 529 plan distributions. What are some of those changes?
Let's see. I'll touch on this first bullet here on the screen, the 10,000. So in 2026, those expenses for the K through 12 tuition, that's going to go up to $20,000 from this $10,000 mark. That's starting next year. But then effective already is the expanded definition of higher education expenses to include non-higher education expenses. So that includes not just tuition to these K through 12, but other expenses. They mention in the law things such as fees for tests. I think even other sorts of school fees can be involved, education therapies for children with disabilities. And then we're, as you noted on our slide here, that we're specifically interested in licensing related expenses, and the education related to those licensing expenses is going to be included in that definition. So it gives people who maybe have gone through school and have some extra money in the 529 plan and are going into one of these areas where there's some additional, I guess, hurdles to cross before you're involved in your profession. Those exam and training sort of expenses to take that exam, or education expenses, would be allowed to be run through the 529 as well.
Great. All right, one last individual tax update here. It's the creation of these new Trump accounts. Let's just talk briefly about this, as I'm sure people have a lot of questions, but I think we can safely say a lot of those questions will not be answered immediately, and we need to get some guidance on this area.
True. We're not going to see really anything in this area until probably the middle of next year. It's an interesting area for sure. The law refers to the traditional IRA kind of as a starting point. So if you think of this as an IRA that you can start for a child who's under 18 and then save money for the time period until the year in which they reach 18, there'll be some savings account there, and some of that money is going to be taxable when that child withdraws those funds later. I guess maybe headline grabbing piece of this law is that children that are born in this window of time under a pilot program, so before January 1st of 2029, are going to get a contribution from the government of $1,000. The IRS is going to be administering this, and as Mike had mentioned, they're struggling with their personnel right now, and they have a lot of other things on their plate. So I think it will be a while before we kind of see how these develop and how this process works for people.
Yeah, and practically speaking, I think the setup and rollout of this program, just seems like it could be a little bit of an issue. I wouldn't be surprised if the Treasury Department outsourced it to one of the major banks, to hold the accounts as a fiduciary. We'll see. Any system that gets people saving for the future, though, is probably a good idea. Maybe if you're, about to deliver a baby on December 31st, you might have to hang on as long as possible to get to, 12:01 a.m. on January 1st, 2026 to get your $1,000 from the government.
We'll see. I know. It'll be interesting to see if we have some stories.
All right. So before we move on to the business updates, I just have one more question for both Shannon and Kevin. Kevin, you did allude to this a little bit. So when these federal tax changes are put into effect, not all of the states immediately conform or follow the same federal tax laws. Do you have any thoughts on state conformity and which, if any, of these provisions that we've discussed, we should be on the lookout for when it comes to tax planning for state tax returns?
Well, I'll speak briefly about Oregon, and then I'll let Shannon take the more difficult state, at least, which is California. In Oregon, generally, we do conform. It takes, the legislature actually has to say that we're going to do it, and they establish a date. So I'm generally optimistic that we'll conform to the majority of these things. If not, some of these provisions we've talked about are going to create some pretty challenging items to work with, especially in that itemized deductions if we're making a lot of differences between the federal and the state. But maybe Shannon wants to chime in about California.
The answer is not complicated, actually. California conforms to nothing, generally speaking. So I doubt that California will conform to any of this, frankly, which, again, the answer is not complicated, but that does make tax preparation complicated for those California folks.
All right. Thank you, Shannon, and thank you, Kevin. We're going to move on to some business tax updates. We're going to start with Gary from Colorado. Gary, let's talk about Form 1099 information reporting. What are some updates here in this area that we need to be aware of?
Absolutely. So the major changes here are a little bit more friendly to businesses. Back prior to 2021, talking about Forms 1099, K. This is payments issued by credit card and other processors. The threshold was $20,000 and 200 transactions. That was because of some pushback. That threshold was put on hold, and that threshold is now coming back for 2025. And so basically, you won't be receiving a Form 1099K unless you receive more than $20,000 and 200 transactions. Okay. Most companies are going to be concerned about the forms 1099 NEC and 1099 miscellaneous, and there's a similar taxpayer or business friendly rule change, and the prior rule of $600 of payments is increased to $2,000, and so the quantity of those forms most likely will be decreased.
So maybe the accounting systems and processes will need an update here in this area, for the businesses and their payroll providers to track this sort of information and then report it on the 1099s. Hopefully all those service providers in that area will make this somewhat easy for people to implement.
Yeah, and an action item is always when you're paying a new vendor, for the businesses out there, it's always best to get a W-9 before you issue your first payment, and then you don't have to worry about if you're crossing that $600 threshold or the $2,000 threshold. You have that information if and when you need to issue the form.
All right, let's switch gears and let's move over to bonus depreciation, and then we'll talk about Section 179 expensing. What are some of the changes here in this area?
Well, bonus is back, and it's back in a strong way. It was 100% back in 2017, and then it was slowly decreasing. And it was going to set to expire, but now it's back at 100%, and it's back permanently. as Shannon defined permanently. So, for qualifying equipment, it's going to be, for the most part, an immediate expensing of qualifying equipment.
Are there any industries in your client base that you think can benefit most from this provision, or is this something that really any business is going to be able to benefit from?
It's pretty much every business, and whether it's manufacturing that has significant machinery and equipment that they're putting in service, that's a large deduction, down to service providers that are buying, cell phones and printers and computers and whatnot. They'll get to deduct those. So it's pretty much across the board, a benefit for just about every business.
Great. Okay, so I'm going to skip past that second slide, and we're going to circulate out all the PDF version of all the slides to all the participants today, so you'll be able to see all the information in here. Let's talk about Section 179, Enhanced Small Business Expensing. What should we know about this topic?
Well, again, the Section 179 was always in place, and what this bill does is it increases the amount that can be immediately expensed, and it's works similarly as bonus depreciation. And so because bonus depreciation is 100%, and Section 179 now allows $1.2 million to be expensed, you have this question about, well, what's going to be better? And each one has their pros and cons, and so that's why it's going to be important for businesses to discuss with their tax advisors, if they have significant qualifying property that they put into service, what's going to be most beneficial for my situation? Is it going to be bonus, which is unlimited, and if you put in significant property in place that, if you expensed it all, would bring your business into a loss situation, that could offset other income. Whereas Section 179, it would reduce your business income down to zero, and then the excess would get carried over to following years. And there's lots of nuances about which one would be better. So that's why it's very important to talk about the options with your advisor.
Yeah, definitely agree. All right, another big one. I know a lot of people, at least in the tax advising space, are excited about this one. So I'm sure a lot of the clients are either excited about it or will be when they hear about some of the details. It's the research and experimental expenses, or what we think of as the R&D expenses. What are the updates in this area?
Yeah, for my clients, this is one of the larger items that they're gonna receive a benefit. It basically reinstated the ability to fully deduct the research and experimental expenses when they're incurred, as opposed to amortizing them over 5 years. And so what it also does is, for small taxpayers defined as, I think it's $31 million or less in average sales, it allows them to deduct prior expenses that needed to be capitalized in a couple of different ways. One option would be to go back and amend your prior tax returns, and that would give those taxpayers a reduction of tax for prior years. Another option is to take those unamortized expenses and deduct them either immediately in 1 year or over 2 years. And again, this is something that, depending upon your tax situation, you might not want to go back and amend, but deduct it in the next year or two. But overall, this is going to be a big benefit, benefit to a lot of taxpayers.
Yeah, obviously we need some guidance from the IRS in this area, especially for these small businesses that qualify that can make the election to go back and expense. Um, like it said in the bill, we have it on here, the election to do that has to be made by July 4th, 2026. So we're pretty sure we'll get some guidance, but no later than July 3rd, 2026 on that item.
Yeah, no doubt we'll get the guidance at the 11th hour.
And there has been some articles written, wondering by various tax practitioners, can we make some of these changes, for a 2024 return that hasn't been filed yet because, it's effective for tax years starting after 2024, but you can elect, if you're a qualifying small business, you can make this election for years after December 31st, 2021. So I think, we'll probably see something from the IRS in that area pretty soon, because there's a lot of commentators in the tax space already talking about this. So we'll say to be determined on can you file your 2024 return and make this election somehow. They haven't even told us how to make the election, so it's uncertain at this point.
Yeah, it is. It's interesting that the law talked about for 2024. If you want to make the election, you have to do it on an amended return, when many have not even filed their original.
Because the return is still on
so,
extension, right? They haven't even filed yet. They might have to.
So it is certainly interesting. It gives us lots of things to ponder.
All right, let's talk about the pass-through entity tax, or PTET, SALT deduction. I think a lot of people know what this is for pass-through entities, partnerships, and S-corps. But how does this interplay maybe with the $40,000 individual SALT deduction cap, and what should everyone know about the PTE deduction?
Yeah, so the good news is it remains and it remains a good and viable regime for getting around the what was the $10,000 cap and now the $40,000 cap. What might be, because of that increase from the 10,000 to 40,000, it might be attractive to elect out of the PTE regime and go back to paying your state taxes individually. I would caution taxpayers that are thinking that, because there might be other limitations at the individual level, especially if your income is going to be increasing and that $40,000 cap is quickly reduced back down to $10,000. But generally speaking, the pass-through entity regime is a very viable way of getting around the SALT limitation.
Great, thank you, Gary. Let's welcome Stephanie on. Steph, let's talk about the employee retention credit. They made some changes to this, but it wasn't as widespread as maybe some people thought it was going to be. What happened here with the ERC as part of this bill?
Good question. And just a little bit of background on this. The employee retention credit was enacted due to the COVID-19 legislation, and it was a means to allow taxpayers, business owners, to retain employees and keep employees on payroll and receive a credit. Now, there were a lot of restrictions on who was eligible for that, and there was a lot of opportunities for taxpayers to claim the credit if they weren't necessarily allowed. And so this legislation is an attempt to kind of claw back a little bit, but it's not really as effective as what you would think it would be. For example, one of the things that they are doing is assessing penalties for promoters of the credit to make sure that they've done their due diligence on if a taxpayer is qualified to take the credit. However, the penalties are not effective until July 4th of 2025. And by then, most all of these claims were filed. So that really wasn't a big impact. Also, the claims related to Q3 and Q4 of 2021, if they were submitted after, I believe it was January 1st of 2024, those are not going to be paid out. The IRS has said that those are not going to be eligible claims. To me, one of the big things, the big takeaways on this is that the IRS did extend the statute of limitations for the 941s and also the income tax filings to 6 years. One of the big provisions of the ERC is taxpayers are required to reduce their wages on their income tax filings, whether it's on their partnership returns or S corporation or even a Schedule C. And that effectively is making it so these credits are taxable to the taxpayer, and the statute of limitations is being extended out for that. So that to me is kind of a big deal because that gives the IRS a much longer window to look at these credits.
I agree. And they certainly don't have the staffing level to look at every credit during the normal statute of limitations, which is probably what caused this extension of the statute, so they have some more time. But they've only really limited, here the third and fourth quarter claims for the ERC. They'll say we're not going to pay out those if they were filed late in the cycle. But I think that the only Q4 claims were for recovery startup businesses, or there was a really limited window for people to actually even get a Q4 2021 claim. And the Q3s, things were starting, things were on the road to recovery in the economy by that point in COVID-19's life cycle. So I think there was probably fewer claims in those 2 quarters to begin with.
Exactly. So not a lot of impact. It'll be interesting to see kind of how that plays out in the long run and how much clawback we get from the IRS. But we're still seeing taxpayers that are now receiving their credits, like right now.
Finally getting a refund.
So it's amazing how long it's taken for these to be processed.
Yeah. All right, the Section 199A QBI deduction. This applies to some businesses, and what's changed here? This was a new provision that came out of the Tax Cuts and Jobs Act, and what's changed?
This is another provision that became permanent by, our IRS definitions of what permanent really means. And taxpayers get the 20% deduction on qualified business income. There are some phase outs with this, and there's a lot of different nuances with claiming this deduction, but it is very taxpayer friendly. One of the items that did change is they added a new minimum of the $400 deduction as long as you have at least $1,000 of qualified business income. And qualified business income is really income from a pass-through entity, a trader business that, is an income producing activity. They've also increased some phase-in limits, which that has the potential to give a bigger deduction to certain taxpayers that are within these phase-out thresholds. You also want to make sure that you plan for this credit and look at some opportunities to ensure that your entity is lined up to take advantage of these. Look at things like your payroll that you're reporting, your capital expenditures, because these are all things that could possibly have some limitations on the amount of qualified business income deduction you can take advantage of in a given year.
All right. We have a few more topics on our list to cover today. I just want to let everyone watching know that we're going to go a few minutes long over the top of the hour here. So we hope you can stay on with us as we get through the end of our topic. So let's talk about excess business loss limitations. I think, was this going to sunset with the TCJA and now it's sticking around, or what should we be aware of here?
That's exactly right. This is another one that was made permanent with this new tax bill. There's not a lot of changes to this, and unlike the 199A rule. This is one that's not very taxpayer friendly. So what this is if a taxpayer has a large amount of excess business losses, meaning losses that exceed a certain threshold, it's like about 300,000 and some change for a single taxpayer, 600 for married filing joint. These are adjusted for inflation each year. And so these losses, what happens if you have these excess losses is they are suspended, meaning you can't use them to deduct other sources of income in a given year, such as your wages or other investment income or other types of income that you're hoping to be able to offset. They kind of get stuck, at least for a little while. What happens is these losses are suspended, and then in future years, they're converted to net operating loss deductions, and they're able to be utilized to offset other income in future years subject to NOL expensing guidelines, which really is you can only offset 80% of income in a given year.
Okay.
And I think
right.
one thing on that, just real quick, if you are a business that will have big losses, maybe consider that if you're looking at opportunities for if you're going to take, you know, this 100% bonus depreciation and other expensing, you know, is it really going to give you the tax benefits right now, or is it something that's going to carry forward to future years? So just know what's going to happen with some of those expensing limits.
Okay, let's move on to qualified production property here. I mean, one of the questions I have here is this really designed to support, you know, domestic manufacturing, or, you know, like, you know, what should we be aware of here?
It is, and this one is a brand new one under this big beautiful bill. It did not exist previously. It is geared towards businesses in the manufacturing, chemical production, refining industries, and it's very tax favorable for those industries. What it's doing is it's allowing these businesses to take 100% bonus depreciation on what we called qualified production property. And qualified production property is non-residential real property. And this is a big deal because real property, real estate, you normally cannot take bonus depreciation on, period. There are some ways around that. You can carve out, you know, shorter lived assets and take bonus depreciation on certain assets, but as a general rule, real property is not eligible for this bonus depreciation. So if you're in these industries and you are constructing a real property during this time frame, and I believe it's construction begins after January 1st of 25 and through January 1st of 2029, construction has to begin in this period, and you get the deduction when that property is placed in service, meaning it's eligible for use. And it can be placed in service all the way through January 1st of 2031. So it just has to start before 2029, and it might take a couple of years to finish construction. You still get that benefit when it's placed in service as long as it's within that time frame. And so this is something that could be a big deal for taxpayers in those industries.
Yeah, because this is brand new, we'll figure it out as we go.
Right. And there are limits, like everything else with the IRS. There are always limitations and exceptions and different things. Certain use of the building doesn't constitute the manufacturing, and, you know, you're not allowed to take it even if it's a manufacturing business. But, you know, we'll have more guidance to come on this, I'm sure.
I'm sure as well. Definitely. That's sort of the overarching theme. Guidance is forthcoming. One more topic here for Steph. It's qualified opportunity zones, and these are a way to get people, you know, investing in parts of the country that are designated as opportunity zones that are trying to revitalize some communities. And there's been some changes in this, which helps people defer their capital gains. What's going on here?
Yeah, this is a mechanism to allow tax incentives to help fund areas that are really kind of low income type of areas that the government designates as these opportunity funds. So what happens is if a taxpayer has capital gains in a given year, they can, instead of paying tax on those capital gains, they can reinvest into these qualified opportunity zones and defer their gain on the tax, or the taxes on their gain. It is a temporary deferral. However, under certain situations, it can be a permanent deferral, and that could be a big deal for a taxpayer. Some of the things that changed in the opportunity zone in this bill is that after 5 years, you get a 10% increase on your basis on your deferred gain. So that kind of gives you an immediate benefit after 5 years. You're already kind of permanently deferring some of that gain after 5 years. And then after 10 years, your investment increases to the fair market value of whatever your new investment is once you dispose of it. And what that does is it effectively eliminates your gain on the original investment that you originally sold back then and deferred the gain on. So it's kind of a big deal. There are quite a few reporting requirements related to this. And this is one that I definitely would recommend you consult a tax advisor and a professional on, because there are penalties associated with the annual reporting and the disclosures. And the IRS is really kind of cracking down on wanting to make sure that these are being complied with appropriately.
Do you have a lot of clients invested in QOFs already, or are they interested in this and asking you questions about this? Or is this a topic that a lot of people you think are unaware of?
I think some people are unaware of it, and we've seen some of them, not a whole lot, to be honest, but we do, we have some areas here locally in Las Vegas that I know are qualified opportunity zones, and if investors get involved in this is definitely something they need to be aware of. It's also kind of possibly an alternative to 1031 exchanges, which is another mechanism to defer gains, where 1031 exchanges are only geared towards real estate. This is something that can be applied to other types of capital gains. So it's a little bit broader, but the reinvestment opportunities are a little bit more well-defined.
Thank you, Stephanie. Let's move on to Steve. And I know we're going a little bit long here. We'll probably wrap up within the next 10 minutes or so. So thank you to everyone who's sticking around through the end. Steve, welcome. And can you tell us a little bit about what's changed here for corporate charitable deduction limits?
Yeah, and I'll try and be real brief here. There's now a 1% floor on deductions for charitable corporations by corporations. The previous law, the corporation could deduct 10% of taxable income, and that's before the charitable contribution deduction. The new law now adds a 1% floor, so you can only deduct contributions that exceed 1% of taxable income before you can start deducting up to the 10% limit. Charitable contributions disallowed for either exceeding the 10% minimum or failing to reach the 1% minimum can be carried forward for 5 years on a first in, first out basis. And this is effective for tax years beginning after December 31, 2025. And what this means is the company has to exceed 1% of deductions in the current year before any of their charitable contributions start. And then you can deduct up to 10%. So a planning tip would be the corporations need to start doing some planning to make sure they're either utilizing donor advised funds or making multiple year contributions in a single year and then skipping other years on the contributions. That way they can maximize their deductions for charitable contributions.
So they group their contributions, for 2 or more years together and make a big contribution in 1 year when they know that they're going to qualify by hitting the 1% floor.
That's correct.
All right. Section 1202, qualified small business stock, got an update, which I think will be, I think a lot of people will be excited if they can qualify for this one. What's changed with QSBS?
Well, without a doubt, what they've done is they've expanded the qualified small business stock gain exclusion. Previously, the qualified small business stock required a 5-year holding period before anything was excludable. New rules issued after July 4th, 2025, there's now a 3-year holding period, and that equals a 50% exclusion of the gain. If you hold the stock for 4 years, then you get the holding period, then the 75% is excluded. And if you hold it for 5 years, 100% of this gain is excluded on the sale. And this replaces the old all or nothing rule and allows for earlier liquidity without forfeiting all of the tax benefits. It provides for an increased exclusion cap. The old cap was $10 million, and the new cap is now $15 million and will be indexed for inflation starting 2027. This allows investors to exclude more of the gain from taxation, especially for it's especially helpful for larger exits. It also provides for an expanded company eligibility. The old law had $50 million of gross assets was the maximum. The new threshold increases that to 75 million, and that amount will also be adjusted for inflation starting in 2027. This will enable larger startups to qualify for small business treatment, especially in capital-intensive sectors like the tech sector and life sciences. Let's see.
These are some really good increases, and not just with this QSBS change, but all the changes we've talked about that have amounts that are indexed for inflation. That's a taxpayer-friendly change because as inflation happens over time, if your tax benefits also are indexed to inflation, then that helps us all rather than the dollar amounts being fixed for some of these things over time. So I think this is very attractive.
And then lastly, it provides for a grandfathering of the old law. So we now have two parallel systems now exist. The old law is a 5-year holding period with a 10-year cap, $10 million cap, and a $50 million gross asset limit. The new law has a 3, 4, or 5-year holding period with a $15 million cap and a $75 million gross asset limitation. And what we kind of say is engage a good tax advisor early in the process if you think this is an option for your company. You just want to make sure you document and you don't go over thresholds to qualify for not having to pay tax on some or all of your gain on the sale of your C corporation stock.
Yeah, you really need 3 participants here. You need the individual stockholder, the tax advisor, and the business itself does have to participate here because really the business has some of the information that's very pertinent to this determination on whether or not the individual stock will qualify for the QSBS gain exclusion.
That's very correct.
And I'll add, because of that 3-year holding requirement, it was reduced, and it gives an opportunity if you think your business might be sold, in 3 or 4 years, and you're not currently a C corporation, you should speak with your advisor about, maybe changing the nature of your entity, and therefore be able to take advantage of this.
Thanks, Gary. All right, we've got a couple more topics here today. Let's talk about business meal deductions. And
okay.
I think this may not be as welcome for the employees on their end. But what's changed here, Steve?
Well, previously, all expenses paid or incurred after 2025 for an employer-operated eating facility, including food and beverage, were disallowed. The new law now allows a 100% deduction for meals provided at the convenience of the employer within certain limitations. This, in Las Vegas, this is applicable because the hotels have a help stall or a cafeteria for their employees, so they take a short break and they don't leave the premises so they can get back on their dealing positions within a short break period. So this is big for our economy here. The other thing is in 2025, business meals deductions are governed by a mix of IRS rules and temporary provisions. Under the new law, here's a breakdown of what's deductible. Certain meals are fully deductible if they meet certain criteria. They must be provided by a restaurant which includes dine-in, takeout, or delivery, incurred between January 1st of 2025, so retroactively, up through December 31 of 26. And they must be directly related to business activities. These would, so the 100% deductible meals would include meals with a client or a prospective client at a restaurant, meals while traveling for business, business meals from restaurants, like staff lunches and that, and then takeout for business meetings from established restaurants, and then food at company events if purchased from a restaurant. And if the meal doesn't meet the 100% restaurant rules or falls outside of the temporary window, it may still be 50% deductible under IRS existing rules. And we recommend that you always keep adequate records for business meals, where, when, and how much is on the receipt. We recommend you keep that and add to it right on the receipt. When you're, most of the time you're going to put it on a credit card, put right on there who you entertained and the business purpose. It can be very brief. And then the second part of that is set up your accounting system or your bookkeeping so that you keep track of the 100% deductible meals versus the 50%. So you don't have to go back and do that at the end of the year when your accountant is turning around and asking, what's the breakdown?
Yeah, you don't want to get a shoebox full of receipts the day before the tax returns due and have to try to sort through that with them, I'm sure. Right. Okay, let's move on to our final topic for today. This is a number of energy efficient property credits. A whole slate of them are being terminated with various different effective dates here. So what should everyone know about some of these clean energy credits? And is there anything they should consider that they may be able to take advantage of here in the really short term before the end of the year, probably?
Yeah, absolutely. And I'm only going to hit on the consumer focused credits that are slated to terminate. There's quite a few different for businesses and for facilities. So the energy efficient home improvement credit terminates December 31, 2025. So the end of this year. The residential clean energy credit terminates December 31, 2025. And then the previously owned clean vehicle credit also terminates at December 31, 2025. However, the clean vehicle credit terminates after September 30th, 2025. So you still have 40 days right now if you're considering buying one of the vehicles that qualify. And there are restrictions on that. So I say, if you're going to do it, you better look into it fully and act now, because there's not much time left.
Is that for a new vehicle purchased from a authorized dealership that is on the approved list, basically?
Correct. Okay. And I think they have to be assembled in the North America.
Yeah, there's not much time to take advantage of that, is there?
Right. And then there's also another one is the new energy efficient home credit, which terminates for homes acquired after June 30th, 2026. And what I would advise our clients right now is, you should be maintaining detailed documentation to support eligibility under the tightened rules. Just want to make sure you document so that if you are challenged down the road, you can qualify for the credit.
All right, thank you, Steve. We are at the end of our material today. We have gone a little long, so we're not going to be able to get to all the questions, but for those of you that have put questions in the chat, to the extent that we have your contact info from the registrations, we will try to reach out to you to answer any questions. And if you have any questions about any of the topics here in the OBBBA or anything else that Singer LEWAC can help you out with, please reach out to your Singer LEWAC representative or one of today's presenters, and we would be happy to advise you, and help you with your tax planning, your tax preparation, and everything tax related. I want to thank Lorianne and her team for setting up today's webinar, and thank you to Shannon, Kevin, Stephanie, Steve, and Gary for presenting with me today on this topic. Thank you all for attending, and we look forward to seeing you on future webinars.